here from Sage Investors, and this is take number 23. Happy New Year, everybody. And usually at this time of year, when we're starting a new year, we're pondering what we're going to be doing for the next 12 months. We set goals, we set expectations, and we try to carry them out as best as we can. Investing is no different. And usually at this time of year, we're hearing all kinds of predictions and forecasts from all kinds of people from Wall Street, Bay Street, wherever, telling you where the markets are going to go, where stocks are going to go, are we going to be in a recession? And a lot of times, a lot of that is just a lot of hot air. It's just a lot of empty calories and really doesn't, as individual investors, just doesn't really help us to really get us to the places that we're at, because predicting what's going to happen in the next 20 minutes, let alone the next 12 months, is pretty much impossible. And anybody that's going to tell you that and can do that with any element of consistency is basically lying to you. One of my most common phrases that I get asked about a lot of things with respect to investing in the markets. And a lot of times I'll say, you know what? I don't know. I have no idea where interest rates are going to go. I have no idea where the dollar is going to be. I have no idea where the S&P 500 is going to be 6 months from now. I have no idea if we're going to be in a recession. I just don't. But at the end of the day, we make decisions, and we make decisions based on educated guesses. And that's ultimately what I do as a coach, as an investment coach, is I teach people how to make decisions on their own and not be dependent upon institutions and banks and financial advisors. While they can be helpful in certain circumstances, at the end of the day, the money that we have, the money that we're saving, it's ours, and we want to make sure it's being put to the proper use. And the only people that are ultimately going to be able to do that as effectively and efficiently is the people we look into the mirror every morning when we get up. So today I just want to kind of go through my mind map that I'm doing right now as I look forward in terms of how I'm going to frame decisions over the next 12 months, over the next upcoming year. One of the things that's very common and very consistent with people that I know who are really good at this investing thing is their plans and their strategies really don't change much from year to year. Often their investing ideology is very constant, very consistent, and it's really all about execution and staying true to it. And so one of the things we want to do, at the point where we're starting the year off, is we just kind of want to review and make sure we're cool with the investing ideology and our plan, our financial plan, our investing playbook that we've put together, or hopefully have put together, and just kind of reset and refresh and just recommit to it. And so that's one of the first things I usually do at the start of the year, is just making sure that my investing ideology, that I'm understanding what my investing ideology is, I'm understanding what my playbook is, and because that's going to help me more effectively frame my investing decisions. And so for me, my investing ideology, as I said, it's very constant. It's pretty stable over the years. It's very sticky. And it revolves around the same principles in terms of making decisions, putting my money into investments that are high quality, that generate strong returns on invested capital, and ultimately, hopefully, that I have positions in those type of investments at a low price point, which will allow opportunities for it to appreciate over time, over the short, medium, and long period of time. And ultimately, that's what I make every decision based on it. So when I'm starting the year off now, probably in a different space in a sense. My ideology is the same, but the way my portfolios are looking right now are probably different than what they've normally been. And this has been a product really over the last year where we've been in a very different mindset than what we've been over the last 15, 20 years. We're living in a world of much higher interest rates, much higher costs of capital. And, for me, historically, I've been more skewed exclusively to stocks. And as an investment coach, I teach people how to buy and sell stocks. I teach people how to evaluate ETFs. That's been my core. That's my core, frame of knowledge that I share with people. The last, year or so is different because now we've got interest rates. We've got other opportunities to get yield at lower risk points. And with interest rates being so high or relatively high, historically, that has found my way into my portfolios. I've my portfolios over the last year have skewed a lot more towards fixed income, towards high interest savings type of investments, and skewed a lot more to banks and financials. And these are areas that historically, for me, I've never really had any of that in my portfolios. I've been all about stocks and equity-based ETFs and index funds. And so the last year was a good year, but it was different in the sense that a lot of the returns that I was able to generate were really coming from the fixed income side of it. Yeah, granted, there was some good equity returns that I was able to generate by owning or having some exposure to some of those Magnificent Seven type stocks periodically throughout the year. But a lot of the heavy lifting was really done by a lot of the fixed income products. And so that's been the mindset. And despite all of that, my ideology has still remained the same. I still want to own stocks. And when I do want to own stocks, I want to own high quality investments, high quality blue chip kind of stocks, generating tangible wealth, and try to find those stocks when they're at a lower price point. And so that ideology is still intact. And with my expectation now, and given the signaling that we're seeing from the central banks that at some point in the future, interest rates are going to probably come down. And when they do come down, I do think that I will probably see myself pivoting out of a lot of the positions that I've had in fixed income, not especially in fixed income, in cash and high interest savings, and pivoting into more what is normally my comfort house, my wheelhouse, which is owning stocks. So one of the things I do expect to be doing over the next 12 months is to be kind of reallocating a lot of my savings into more traditional type investments that I've normally been around. So that's one thing I'm probably on my to-do list that I see myself. I see the portfolio that I have, the way I have them set up right now, being a lot different toward the end of the year, by the end of the year. And we'll get into that. I'll talk a little bit sort of what I'm thinking right now in terms of how I'm trying to frame my decisions over the next 12 months. So before we get into what I'm thinking about for the future, I just want to do a quick reset on terms of what last year was and decision-making that I was making last year. Well, last year, the baseline for me in terms of how I frame my decisions was really all about the yield curve. Again, it was all about interest rates. As short-term rates were going up, long-term rates were staying kind of dormant. And what we still have is very much an inverted yield curve. And history has shown, and the charts have shown, that inverted yield curves tend to lead to some kind of economic slowdown, some kind of recession. Wall Street was pounding the table for it where I sat like a year ago. And I think they've jumped off the wagon there, but I'm still on the side of it that, I could see us still walking into some kind of slowdown. I don't know when it is going to happen. I don't know what it's going to look like or how intense it's going to be, but I do see some element of a slowdown. And we're starting to see that in some of the basic economic data points in terms of jobs. They're healthy, but they're trending down. We're coming off the pandy. And we're going back to kind of a normalization of things. And the normalization from where I'm seeing is probably some element of a slowdown. Again, I don't know how bad it could be or how, long it could be. That's my mindset. That's how I'm baseline framing my decisions. So at some point, if that does ultimately play out, and inflation, that's the other big bugaboo out there, continues to be kind of, tracking downwards. At some point, central banks are going to start cutting rates. And if rates go down, then I'm ultimately going to have to adjust the way my portfolios are going to look like. And that's kind of where I'm starting my baseline in terms of looking at decisions that I'm going to frame for the year. So that's my mind map right now, is what do I do in the event of interest rates going down whenever they go down? So right now, the Federal Reserve and most of the central banks are kind of mind mapping out. They're telling us that they expect to cut interest rates 3 times maybe this year. Wall Street, Bay Street, a lot of the market smart money people are basically covering their ears and saying, no, you're going to cut it like 6, 7 times. And I don't know how realistic that is. And given the fact that Wall Street and Bay Street have been extremely wrong in their calls over the last 3 years, they've been incredibly consistently wrong on everything. I really don't know why we bother listening to them. So the people that have been actually quite right have been the central banks. They have been on point and on message telling us, hey, interest rates are going to go up until inflation comes down. Now the message that's coming on is inflation seems to be under a little bit more control. The conversation now is looking not at increasing interest rates, it's looking at decreasing interest rates. And right now, they're being very careful, they're being very cautious. But at the same time, the messaging has been pretty clear that rates are going to come down at some point. So that's the baseline. And one of the things I write about and I've talked about and I tweeted about, I don't really tweet any much anymore. I thread out stuff, is don't fight the Fed. If the Fed says rates are going to plateau and come down, you manage your investments accordingly. And so that's kind of where my baseline is starting in terms of how I'm framing my decision. So if rates at some point are going to come down, what does that mean? What it means is opportunities, usually historically, when rates go down, cost of capital goes down, interest costs go down. That's good for profitability. That's good for stocks. And ultimately, stock prices reflect that reality. The other side of the trade, as I said, I have had a lot more exposure to fixed income. And so one of the things I'm thinking about also is that if rates do start going down, that's good for bond prices. That's good for bond prices and capital appreciation for bonds. And so I could see myself in terms of my fixed income positions, holding on to those fixed income positions to benefit in the short term from the higher coupons that I'm getting from holding bonds. But in the medium to long term, ultimately, if interest rates do go down, those bond prices are probably going to start going up. And so, bonds have been lousy in terms of capital appreciation for the last 2 years. It's been historically horrible. Maybe we might be starting to see an upswing in terms of capital appreciation for bond prices. And so that's kind of one of my mindsets right now, is that the positions that I have in high interest savings accounts, which are very sensitive to what the central bank rates are. If central banks start reducing interest rates, then I probably could see myself pivoting out of those positions that I held in high interest savings account, which is quite a bit. I had about, I believe I have about 25% of my portfolios are in high interest savings. So it's a chunk of cash there. I could start seeing myself reallocating some of those positions into long-term kind of bonds, short-term kind of bonds, and ultimately stocks. And so that's one of the things I'm looking at right now, is I could see myself pivoting out of those positions into more fixed income kind of positions to take advantage of those potential capital appreciation opportunities. Now, are they going to take place? Wall Street and Bay Street are saying rates are going to come down like in March. Well, I have no idea when they're going to come down, but whenever they do come down, I want my portfolios to be positioned. So I could see myself skewing my portfolio a little bit, pivoting out of high interest savings into more fixed income oriented type things, and also as well as into stocks. So one of the things I'm looking at from an equity perspective, as I said, I could see myself increasing more exposure to equities, traditional type equities, is looking at potentially emerging markets. Last year I had a good run with emerging markets. I was specifically targeting Mexico and India last year. I had positions in through ETFs in those areas, part of the world, and they did pretty well for me. And I still own my India position, and I'm looking to potentially add more. But I'm looking to add more exposure to to emerging markets. Again, trying to make an educated guess. Usually when interest rates are falling or getting lower, that's been historically good for emerging market equities, emerging market investments. So I'm looking to probably increase my exposure slowly throughout the year in that space. Now, the thing you got to be careful though is, as I said, one of the reasons I owned India and Mexico last year, and I just didn't, traditionally I've always just owned a basket of emerging market, ETFs. But the thing with the emerging market ETFs is they are heavily skewed towards China. And if you looked at the performance last year for emerging market ETFs, with China included, it was not very good. If you stripped out the China component, they did pretty well last year. And that's right now my take on China is right now, I don't think it's investable anymore, given all of the political issues and the, all the garbage that's going on right now. From that perspective, and what we've seen in terms of how they've treated their bread and butter industries, it's just not investable, I don't think, anymore. And I think a lot of the companies that have been pouring money into China are slowly starting to take it out. As one of my big calls from the post-COVID thing was, we would start seeing a regionalization of supply chains, and I think that's what is happening right now. Apple is looking to actively get out of there, even though it's their biggest market. So there's a lot of issues there. And so when I'm looking at emerging markets, I'm trying to look at basically anything without China in it, with no China in it, basically anything else. India, Mexico, I think, are one of the big beneficiaries of the whole regionalization of supply chains. I think they stand to benefit quite a bit from it. Still have some issues with India in terms of the government concept around there. I think there is a little bit of, I have a lot of issues in terms of how the nationalistic approach over there is that. But at the end of the day, from an economics perspective, it's a player. So emerging markets is one of the things I'm looking at. In terms of traditional developing markets, at some point, I could see myself starting to build exposures into more of the broader markets through low cost index funds. Right now the S&P 500, most of the developed are pretty stretched in terms of valuations. I think I would need to see a real pullback in the markets for me to want to start building exposures into there. So I'm going to keep my eye on it. One of the themes over the past year for me too is I've held a lot of my positions have been, besides the fixed income, I've been owning more individual stocks. I haven't been owning baskets or indexes or in much significant amounts over the past year, because I think, I thought the valuations were more interesting at the individual stock level. But that could change now. If interest rates start falling back, potentially, and if they do fall back, it's because there is that economic slowdown. There's that profitability issue with companies. And so if we start seeing profitability issues with companies and slowdowns, ultimately that's going to feed back into stock prices. And ultimately we could see potentially some fallback in stock prices, some fallback in the broader markets. And that's the point where I would start getting interested in if I wanted to have broad market exposure through ETFs. So I'm keeping my eye on it. I'm watching the small caps, especially the US small caps. They're pretty, I keep hearing about small caps being like a real bargain, but from my perspective, they look pretty pricey. I need to see more pain in that sector for me to want to get interested in it. So I'm looking at that. The other area I'm also, and this is more of a long-term position that I'm looking at, and I've started to build on, is the whole REITs, real estate investment trusts, getting back into commercial real estate. That's been, we all know the story with the pandemic, how it's totally devastated commercial real estate, the whole work from home thing, and everybody just questioning the whole commercial retail space, the retail side of it, all kinds of just dead property sitting around. And we're hearing all kinds of chatter about stuff being converted and into things like that. That's fine. Suffice to say, the REITs have been really beaten up over the last couple of years. So and one of my takes on it, when I'm trying to figure out what could evolve out there and trying to make an educated guess, I think one of the things, and I've posted it about it too, is I think at some point, I think when the fog of COVID is lifted, I think we're going to get a branch of managers coming on board that are just going to basically look out there and say, you know what, pandemic is over, everybody back in the office. We're in this kind of hybrid-y, kind of honeymoon, feeling each other out kind of situation. At some point, management is just going to stand up. Management with no baggage is going to stand up and just say, you know what? I want everybody back in the office. And if everybody goes back in the office, all those buildings are going to start getting filled up. Space is going to be needed. And we could start seeing the pendulum on commercial real estate go from the depths to start popping. And so I think this is not something that's going to happen tomorrow or 3 months from now. I think this is going to be a slow burn, a slow growth area. I think within a couple of years from now, I think all of us are probably going to be in an office working 5 days a week, just like we were before the pandemic. That's kind of my hot take on it. But I don't think it's going to happen tomorrow, but I think we're slowly, like a lot of people are going a couple of days a week, 3 days a week, and it just kind of keeps adding, keeps growing. At some point, if that's the case, fine. We could have a philosophical discussion about working from home and all that kind of stuff. But at the end of the day, if more people have to go back into an office to work, to keep a job, you need space. And this is where, and again, I'm not a real estate expert here. If that's the case, I'm just looking at a macro perspective. If people need space, people need property to work in, I want to own a basket of those type of companies that are involved in that space. And so I'm probably could see myself, and just as a disclosure, toward the end of last year, I did start a small position owning one of the a real estate investment trust ETF, one of the iShares products. I'll do that. So that's another equity kind of theme I'm kind of looking at, and I could see myself further building out more exposure over the next coming year. What else? What other things are kind of out there that I'm kind of looking at that I could see myself getting more involved in over the next 12 months? At some point, if interest rates do start falling aggressively, that's going to help bonds in terms of long bonds, especially because they're more sensitive to interest rate fluctuations. So at some point, if that happens, if that plays out, then I'm probably going to be starting to move out of that position, benefiting hopefully from it, and then moving it back into more traditional equities too. So with the whole narrative of interest rates falling, I'm looking at potentially what next. First of all, benefiting from that in the short term with capital appreciation. But then I'm looking at, as investors, we're always looking long term. What's next? What's behind that? And so, emerging markets is one theme. A couple other areas that I think are evolving investing themes that I'm looking at for the next year. One of the ones that's been constant for me over the last 10 years has been water. I honestly think we've got so much conflict going on in the world. I don't think any of it is really going to, stand any competition to the water conflicts that I think the next great battles around the world is going to be around water. It's not going to be around real estate in the Middle East or anything like that. It's going to be around water security. And I've historically been, and I continue to own a basket of through an ETF, exposing myself to water related kind of companies. And so that's one area I'm looking at. Feeding through on the commodity kind of base situation. One of the narratives that is out there is the whole concept of climate change, growth in electric vehicles, and the underlying demand for commodities to build all of this stuff out. So, materials like aluminum, copper, tin, silver are could potentially be interesting stories. Just as disclosure, throughout the year, I did own some aluminum last year. I did have some copper, which I benefited from. Aluminum I did benefit from, but I sold out of those positions because based on valuation. The mind map that I'm thinking of right now is I'm seeing a lot of numbers out there talking about EV demand kind of falling a bit. And ultimately, if electric vehicles kind of plateau a bit for now, ultimately, that could play into the demand for these type of materials. So one of the things I'm kind of watching out for right now is I'm just watching a little bit on the commodity side and looking for pullbacks in that space. Because ultimately, I think those might be areas where I may want to reallocate some of my savings into getting some exposure into aluminum, copper, I do have some exposure right now to tin. I had some exposure to silver, which I backed out of, not because I don't buy into silver, but more I just didn't like the product. The ETF that I was using to get that exposure, like frankly, sucked. And so I'm kind of looking for another way to get some more exposure into silver because I think it is a long-term investing theme. Other space I'm looking at too that I've been slowly starting to build positions on, and I probably could see myself, especially as if interest rates, do start falling, is the utility side. Again, that's an area that's got schmucked over the last year or so, again, because of the high interest rates. But I think historically, utilities tend to do better in falling interest rate environments. And so, I'm looking at that space now a little bit more as building up some exposure there. Right now, I haven't even talked about technology. I haven't even talked about the Magnificent Seven or any of that. Like, is that going to be part of my portfolios this year? It was last year for a chunk of time, but I profited from it. I didn't get the maximum profit out of it, but I had exposure, and it did definitely help me juice up my returns from last year. But I don't have any of it right now. And again, it comes back to my ideology, is that looking for quality companies, quality businesses, and try to buy them on the cheap. And right now, these companies are not cheap. And so, hey, if the market were to start pulling back again, and we start getting another violent, trade down, then yeah. And if these stocks start pulling back, then yeah, I might want to consider some of these stocks to jump back in on. But right now, I'm not there at that point. So, but it's on my list, and I'm watching them. So that's something I'm going to be probably looking out for over the next 12 months. Same with some of the semiconductor area, the chips side of it, been pretty frothy, but we're starting to see some pullbacks now in terms of demand. I saw something about Samsung demand there, has been pulling back quite a bit. So that's another area I'm probably going to keep my eye on. And if they do pull back, then, again, there could be some really good quality companies there that might start being on sale. And I'm probably going to start looking at that. And I guess one of the final areas I'm probably going to keep my eye out on for this year is the luxury retail space. Got totally exploded last year, but then fell off a cliff, and it's still falling off a cliff. A lot of, even though the fact that these companies are still extremely profitable, the LVMHs of the world, the Nordstroms, the Burberrys, Canada Goose, these are profitable businesses. Nike, RH, those are the ones I look at. That I've historically benefited from, and they're down meaningfully now. And so I've started to build up some positions there. And so that's a place that, if things evolve very nicely with the economy, and it's a space where margins are very sticky and very rich, that's a space where I think there could be some low-hanging fruit over the next year or so. So I'm slowly starting to build out those positions, because right now, again, the market's really hating on them quite a bit right now. And so again, back to my investing ideology: high quality businesses generate tangible wealth, buy them on the cheap. Luxury retail is kind of checks off a lot of those boxes right now. So that's a space, again, I want to see myself kind of building out to, again, as I'm pivoting out of those high interest savings accounts that are paying very nicely 5% right now. If rates do fall, they're not going to pay 5% anymore. And so looking for those opportunities. So as I said, this year last year was weird because I had so much exposure to fixed income and really short-term income kind of things. This year, I could see myself now, if things play out with the whole interest rates plateauing and starting to fall kind of narrative, pivoting into these different kinds of themes. And the whole point, again, as investors, it's all about staying true to your playbook, staying true to your ideology. So I'm hoping that these are the areas that I'm looking at that I think that are very aligned with my playbook and with my investing ideology. And the goal, again, is to make sure we're staying true to our investing ideology, staying true to our playbook. So a lot of stuff that I've talked about today, I'm sharing with you in terms of my thought process in terms of my investment decisions. But at the end of the day, these are my investment decisions. These are not your investment decisions. So at the end of the day, you need to take out your computer, you're out your spreadsheets, you need to get on the web, and you need to do your homework, and you need to do your research. If you don't have an investing playbook, you don't have an investing ideology, this is where you need to work with somebody, you need to come up with something on your own, or work with somebody who's a little bit more well-versed in these type of things to build out your playbook, to develop your ideology, to develop your investing ideology, and then to execute it and stay true to it and stay consistent with it over the long term. Because that's from my experience. The people that really do this investing thing really well, they really adhere to this. They really adhere to these core competencies of education, of learning how to invest, how to evaluate stocks, how to evaluate bonds, how to evaluate ETFs. But then they execute, they engage in the process, they develop a plan and they stick to it, and they through good times and through bad times. And ultimately, those people are confident, they're empowered, and they're not intimidated and not confused by the whole process. And ultimately, the people that I've worked with who build out those competencies tend to be more successful. So I've shared with you today sort of my thought process, my ideology in terms of how I'm thinking about how I'm going to frame my decisions over the next 12 months as we get into the new year. And hopefully you've taken some ideas there in terms of the thought process that I kind of go through, and kind of hopefully start building those type of thought processes into how you make decisions about how you're going to invest your savings. So I hope this was helpful for you. If you want some more information about my coaching services and the investment courses that I do teach them in person. I do teach them online in real time. And I also just teach them online. You can just jump on here and download them and view them at your leisure. You can go to my website, sageinvestors.ca. You can find me. I'm kind of hiding in different places now. I'm kind of off the Twitter X thing. I'm there sporadically. But you find me more on Threads. Just do a search for Sage Investors Nation. I'm on there. And you can also find me on LinkedIn. Just do a search for Sage Investors. We have our company page over there too. So that's all I got for you. A lot of stuff on the table there for you to think about. I hope this was helpful for you today. Thanks very much for watching, listening in. My name is Aman from Sage Investors, and we'll catch you again another time. Take care. Bye-bye.